because our economy is so distorted because of Fed policy, which some might say is irrational, and they haven't found a way to go back to traditional monetary management. They're continuing under this crisis management policy. If we have a significant bubble in our asset markets, which is why the stock market continues to grow, eventually it's going to have to burst. And of course, any administration is going to want to wait for that to happen until after an election. And so that's, I think, why we've seen the president try to convince the Fed to continue to cut rates, to keep the boom going just that much longer, because the worst thing that could happen for a sitting president is a recession that would basically undermine that president's reelection chances. But that just means that we're continuing to potentially inflate this bubble, and it's going to be that much bigger, and the crash as a result could be that much vaster and more severe as well. And we're not in a position like we were during the last recession, where U.S. fiscal finances were on reasonably good footing. The deficit was low. Our debt as a percentage of GDP was 38%. We are now at more than twice that, at 78%. So we don't have the fiscal space to do the things the government did during the last recession to try and smooth it over, like the stimulus plan, bailing out the banks. None of that money that was available at the time is available now because we borrowed it all and we haven't paid it down. So we find ourselves with much less fiscal space. Also, cutting rates is pretty much not possible because they're already at the bottom of where they can be. So there aren't monetary or fiscal instruments that the government will have. So it is actually quite scary because I do worry that when that crash comes, we'll be much less prepared, and people don't see it coming.
Hey everyone, welcome to Finance and Liberty. I'm your host, Dunnigan Kaiser. Our guest today for the first time is Romina Boccia. She is the director of the Grover M. Herman Center for the Federal Budget at the Heritage Foundation. She's an economist there, and she's joining us for this first time on Finance and Liberty. Romina, thank you for joining us.
Thanks for having me.
We were intrigued when we found out through LinkedIn and other sources that you are an expert on the federal budget deficit, federal spending, the risk that can be posed to ordinary wage earners, to the middle class, and to our government and the very existence of our country and the health of countries in general from out-of-control sovereign spending. So we wanted to have you here on Finance and Liberty because not only are these topics vital to people's country finances and their individual family finances as well, but to our liberties as well if we have to sacrifice our wages or our retirement accounts or that sort of thing to pay for these runaway expenses. So we've got a lot of questions for you, some of them from our own, and a lot of them have been submitted by our viewers as well.
Great. I am excited to be on this podcast with you. Thank you for inviting me.
If you could start off by looking at the environment we find ourselves in today with runaway federal deficits of upwards of $1 trillion and more a year, and 20 federal debt of $22 trillion and counting, and we specifically finding ourselves in a situation where that, to most people, those numbers are even unfathomably large. Can you talk to us about the historical magnitude and scale and the pace and the rate of acceleration of what's going on and what you see as the big picture just regarding the size and magnitude of the debt and what it means?
Yeah, I don't want to bring in too many numbers because it can make people's heads spin, but let me give you just a snapshot of where we find ourselves right now, how we got here, and what's driving this out-of-control spending that is driving up our deficits and debt. So our national debt, also called our gross national debt, is now $23 trillion, which is larger than the entire U.S. economy as measured in goods and services, or GDP. That is deeply troubling because economists have identified that when sovereign developed countries like the United States, like many Western economies, basically your OECD nations, when these countries reach debt levels that approximate, or in our case, surpass the size of their economies, and especially if the debt is on a rising trajectory. So it's one thing if you've got debt at 100% of GDP, but you're on a downward trajectory. It's quite another if you're quickly growing beyond that threshold, and that's what we're doing in the United States right now. And when you have a country like that, like the United States finds itself in today, it has a significant and enduring effect on economic growth. It drags down growth. This is the so-called debt drag. And we've experienced this in this country, and we'll continue to experience this. And it's sometimes hard for people to put their finger on it and realize that opportunities aren't as abundant as they would otherwise be, and all the things that aren't being created, the businesses that don't get started, the jobs that aren't available, the technology that isn't being developed that would make us more productive, allow us to earn higher wages, all those unseen costs, to be able to tie those back to a rising national debt sometimes can be difficult for people because these things don't exist, but that's exactly what's happening. And so I think this is one of the reasons why this is an abstract issue for lawmakers, because when we're talking about reining in this out of control spending and debt, we're inevitably talking about some painful policy solutions. And we try to point out that if you reduce spending on this program, if you try to work towards a balanced budget, if you stay within your means, within the government's means, there are going to be vast economic benefits from it. But we have to sort of like point at this abstract benefit, whereas the current choice, the difficult choice the lawmaker would have to make today to restrain spending on a certain program, not to increase the budget by a large amount as they would like to do. That's a difficult choice they have to make today for some promised far-off abstract benefit that we can't fully quantify for them. So this is one of the drivers of this problem. But that broader national debt is a subset of the so-called publicly held debt, which is the money that we borrowed in credit markets, and then the so-called intergovernmental debt, money that we have borrowed from ourselves, so to say. What is that money? It's primarily the Social Security Trust Fund. So it's basically government accounts where the government collected tax revenue, earmarked tax revenue for a specific purpose, but didn't actually save it because our government doesn't have a policy of saving, but instead spent the money immediately and then issued a treasury bond to that government agency, in this case, the Social Security Agency. And if you only look at the debt we've borrowed on credit markets, so the money that we've sold treasury bonds on open markets, that is at about 78% of GDP. It's when you add in all the debt we owe to ourselves, to government agencies, and the retirees that are expecting those benefits like Social Security. That's when you get the 23 trillion, where we're already larger than the size of our economy. And that doesn't account for all the debt that states and localities have assumed that also has an impact on the U.S. economy. And the unfunded liabilities just from the pension crisis in our states and localities is estimated to be about $6 trillion. Now, the federal government is not officially responsible for those pension promises, but lawmakers are currently talking about potentially bailing out private union pension plans, which would set a very bad precedent, because if you're bailing out private union pensions, how can you say no to firefighters and state and local officials and government employees and teachers and all of these state employees that have been promised these pensions that are severely underfunded? So we were potentially talking about easily adding many, many more trillions to our national debt if the government decides to bail out those states and localities. But it already has an effect on our economy because, the states and localities are within our federal structure, and so their debt also has an impact on our country's finances, even if the federal government is not responsible for it.
Wow, you've opened up a lot of different topics there, and I wanted to zoom in on one of them. You mentioned about the debt to GDP ratio, and you mentioned in passing right at the beginning, talking about this depends whether you're in a rising or a falling economy. There's been increasing talk on, especially non-mainstream channels over the past half a year at least, maybe more like a year, that many measures of the actual economy are looking ghastly, that in some ways it appears that the real economy is falling off a cliff, even though we have sort of headline stock indices, equity indices, bond, that sort of thing seeming to be running along unchecked. Can you talk to us about what reality, first of all, what your perception as an economist is of this apparent gap between the economy on the ground? Where do you see that really happening? And what do you think the health of the actual economy is, from manufacturing and everything else, versus where you think this gap leads us to in case of that debt to GDP ratio, if the GDP is actually falling off a cliff?
Yeah, that is a very good question. It's also a very difficult question because our economy is highly distorted. And it is especially distorted when it comes to our money. And that's because the Federal Reserve adopted entirely new monetary policy around 2008 during the Great Recession to respond to it, a so-called quantitative easing that pumped massive amounts of money into our economy that with the intended purpose of inflating assets in the stock market and creating a so-called wealth effect. So this is the demand side economics, where the idea is that if you make people feel wealthy, if you put money in their pockets, they'll go out and spend it, and that's what grows the economy. What it doesn't consider is that prices are a key function of sharing information in our economic system to tell entrepreneurs, to tell managers where to invest, how to invest, what kinds of investments to make, and over what time horizon those need to provide a return. Interest rates are a key input in those decisions. And when you have a Federal Reserve, a central bank, that is explicitly lowering interest rates beyond what would be a natural rate in the market, that is pumping money into the economy to inflate assets artificially, that creates a tremendous amount of distortion, and then makes it very difficult for not just economists, but your investors, your entrepreneurs, your business managers, your governments, to make rational decisions in such a distorted economy. So we find ourselves still in the longest expansion. Some of that is because the expansion at the beginning, our economic expansion, was very slow. Coming out of the recession, we experienced one of the slowest expansions in our economy, in large part because of policies adopted during the Obama administration that were depressing growth and hiring. The Affordable Care Act, or Obamacare, being one of those primary policies, but also policies that were restricting capital through the Dodd-Frank Act. All of these contributed to the slowest growth, the slowest climb out of the recession in our nation's history. And now we're still in that expansionary period. But some of it is, in recent years, also been driven, by good policy, deregulation on the side of the Trump administration. That has had a tremendous impact in boosting business confidence, that has led to more hiring, greater business formation. The tax cuts created a bit of a fiscal stimulus, but they're also correcting some comparative disadvantages, which was that the United States had the highest corporate tax rate in the world, in the industrialized world, before the tax cuts. So the tax cuts corrected that. It allowed for immediate expensing, which encouraged more investment. And we're seeing that now in wage growth and this historically low unemployment rate, below 4%, that is lifting up, especially the most vulnerable Americans. And wages have grown at twice the rate at the bottom 10th percentile, so folks making about $12 an hour compared to the top 10% of wage earners. So that's all good news. But because our economy is so distorted, because of Fed policy, which some might say is irrational, and they haven't found a way to go back to traditional monetary management. They're continuing under this crisis management policy. If we have a significant bubble in our asset markets, which is why the stock market continues to grow, eventually it's going to have to burst. And of course, any administration is going to want to wait for that to happen until after an election. And so that's, I think, why we've seen the president try to convince the Fed to continue to cut rates, to keep the boom going just that much longer, because the worst thing that could happen for a sitting president is a recession that would basically undermine that president's reelection chances. But that just means that we're continuing to potentially inflate this bubble, and it's going to be that much bigger, and the crash as a result could be that much vaster and more severe as well. And we're not in a position like we were during the last recession, where U.S. fiscal finances were on reasonably good footing. The deficit was low. Our debt as a percentage of GDP was 38%. We're now at more than twice that, at 78%. So we don't have the fiscal space to do the things the government did during the last recession to try and smooth it over, like the stimulus plan, bailing out the banks. None of that money that was available at the time is available now because we borrowed it all and we haven't paid it down. So we find ourselves with much less fiscal space. Also, cutting rates is pretty much not possible because they're already at the bottom of where they can be. So there aren't monetary or fiscal instruments that the government will have. So it is actually quite scary because I do worry that when that crash comes, we'll be much less prepared, and people don't see it coming. And I think we're in a period now where folks think, well, the stock market's just going up, 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 unemployment's going down, 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 everything's going great. And when people tend to have that feeling, just like we saw with the last housing market crash, like housing values are only going up, 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 everyone's buying, interest rates keep going down, down, down. It can't go on forever, and what can't go on forever must eventually stop. Are people going to be prepared for that scenario? American households at least have tried to stock aside a little more savings, but we are seeing even there private debt is rising again as people become overly confident in our economy and think that they can over-leverage themselves because they'll make up for it later. That could put a lot of people in a bind. Will the next crisis appear in the housing market as much as the last one? Perhaps not, but we are seeing potential risks in the student loan market and also in subprime car loans, credit card debt. Those may be the areas where people will feel the most pain when the next recession comes.
A couple of things you mentioned I wanted to follow up on. One of them was the statistics that lead us to interpret the economy as having. You mentioned how slow the recovery and slow the expansion was, but several people who watch statistics very closely have said this is nothing you'd want to call a recovery or an expansion, especially in the last year or so, with like record numbers of retail store closings and shipping indices or manufacturers indices dropping off and housing starts dropping off. And you mentioned unemployment being low because that's the official statistic we get told, but the labor workforce participation rate being the lowest in their keeping of records, and also the actual inflation measurements like the consumer price index and so on being adjusted rather than staying fair comparison over time of what people are actually experiencing in their real lives to try to get through the lives of an actual middle class person trying to buy fuel for their car and put their kids in college and pay medical bills and that sort of thing. So can you first talk to us about how real the statistics are that we're being provided to try to convince us that in fact the economy is healthy versus some of these other perspectives?
Yeah. You'd like to ask difficult questions, don't you? There's
trying to get awareness so we can really make sound decisions.
There is this famous saying that it's easy to lie with statistics. It's even easier to lie without them. And so as you already made the case, many of the the factors that people cite as to what determines our economic health, they are flawed statistics. And we do have low labor force participation, but that is still a hangover from the last recession. 1/3 of the decline in labor force participation was from people going onto the disability insurance program. And that is a program that for most people is for life. They never come off. The return to work rate from the disability program is 0.01%. It is not even a rounding error. And so those folks left in the last recession, and they might never come back to the labor force. And then we also have we're experiencing aging in U.S. society, so about 1/3 of the decline is also pretty much permanent in the form of folks retiring and stopping to work at all. And then you have folks that are marginally attached through gig work and other types of work. So yes, the unemployment number by itself is not sufficient. We also need to look at these other indicators. I still think, though, that it's remarkable that our economy is creating more jobs now, about 7 million, than people that are actively looking for work, which is what we measure with the unemployment rate, and that's about 6 million. But then the problem is that we might see a geographic and a skills mismatch between what employers are looking for, who they're trying to hire, and the skills that folks have and where they're living. And many government programs have made it easier, more comfortable for people to stay put and not move to where the jobs are, because rural communities in the United States, many of them are experiencing a population and economic decline. Some of them have found a way to attract businesses and to revive their industries, but many aren't going anywhere. And if those workers aren't moving to where the jobs are, which tends to be primarily in urban centers, then you have a problem there. And then the skills mismatch is another issue, and that relates back to our education system. So you have micro problems that can help explain some of the macro statistics that you see. Inflation is one of those phenomena where you don't see it broadly in the economy, but you do see it in particular sectors, as you made the point. Gas prices have risen, health costs are on a steep incline, especially following the passage of the Affordable Care Act, where premiums have risen 25% in many jurisdictions and don't seem to be going down, but only further up. And yet, because of deflation in other sectors of our economy through technological innovation and the way we measure cost of living increases, it looks like in the broader economy we don't have any inflation, or at least it's below the Fed target rate, which is set at 2%. But then people do experience inflation in very real ways in the things that they buy on a daily basis. And I think that's why a lot of people are fed up with elitists and elite positions that tell them that the economy is going great when they're not experiencing that in their own homes and in their own pocketbooks. But to the extent that we do have difficulties in our economy, I think in many ways we can point back at government overreach, federal government overreach in particular, both through the regulatory state, but also through welfare programs and by dragging down growth broadly with out-of-control spending. I mean, the deficit this year is going to be almost $1 trillion. We're just shy of it. Spending is $4.5 trillion. Revenues are $3.5 trillion. So you have about a $1 trillion deficit, the difference between what the government takes in and what it spends. And that is going to go up significantly, reaching almost $2 trillion per year in deficits by the end of the decade. We're looking at a cumulative deficit of about 12 to $14 trillion over the next 10 years, and that's assuming no new spending increases, which is a big if. And so we're already in a highly precarious fiscal position that we haven't been in trillion-dollar deficit territory since the last recession, but we find ourselves in reasonably good economic times where the economy is growing, people are returning to work, unemployment is low, and yet the government is running deficits as if we were in a recession. What are they going to do when we're actually in a recession? They don't have much space. Oh, yeah, by the way, this is the other big assumption that over the next 10 years, we won't have a recession. The government doesn't forecast recessions. They don't build it into their models, not even as a potential risk. And so anytime you're looking at those numbers, you probably want to add several trillion if you like most reasonable people think that it's quite likely that we are going to experience a recession in the next 10 years. And then ask yourself, what can you do to position yourself to weather that fiscal storm when it comes?
Another one thing before we get on to viewers' questions, you mentioned in passing there, assuming that spending doesn't increase, but here we are in the presidential election cycle, and we've got a number of candidates, even those self-proclaimed socialist candidates, saying that they're promising what have never been promised before in terms of benefits and expending and that sort of thing, as though there's no limit to what the government can do. What do you see as the direct impact if any of those policies become instantiated? Is it in fact going to be distinctly different from what we've seen in the past, or is it just finally people are admitting what's been going on all along?
I am very concerned about our political discourse at this time. If you think back, the United States had a reasonably balanced budget up until the 50s, 60s. And that's when Keynes came along and whispered in politicians' ears that there was a way for them to do deficit spending at no cost. He told them that the government could create prosperity out of nothing during a time of economic weakness. If the government did some deficit spending, that would get the economy growing again. It would pick up slack out of the economy, and there would be no fiscal or economic cost to it. And that was not true, because it was a very theoretical assumption with the other assumption that lawmakers would then pay back those deficits during economic boom times. But what do lawmakers do when the economy is growing and they're bringing in lots of revenue? They spend it and then some. And so we found ourselves in repeated cycles of overspending, which got us to the point today where our budget is so far out of balance. And now we have an even greater risk on the horizon. And that is this theory called modern monetary theory, which is telling politicians, even is taking the next logical step from Keynes and saying, you know what, don't worry about borrowing the money. You are a sovereign nation. You control your own currency. Just print the money. Why would you borrow it from the Federal Reserve? Let's just make the Federal Reserve and the Treasury one and the same entity. No more independence, no more independent mandate, and we just have the Fed produce all the money the Treasury needs to finance all the spending. And that's what many of these presidential candidates subscribe to. The primary proponent of this very dangerous and very wrong theory that will only lead to hyperinflation of the tune that Germany experienced after the World Wars and that Venezuela is experiencing right now. That's what happens when governments print money with no limits, is you get hyperinflation. The value of your money goes to nothing. Just a quick example for people to think about, like, what does this really mean? In Venezuela, in 1 year, they had 10 million% inflation. That means that if you had $10,000 saved in the bank in January, by the following January, just 1 year later, the value of that $10,000 would have been reduced to 10 cents. You couldn't even buy a pack of gum with what used to be $10,000. That is what is going on in Venezuela right now. That's called hyperinflation. And the primary proponent of this theory, Stephanie Kelton, she calls herself an economist, which we might want to question that credential. Given the theory she's espousing. She was an advisor to Senator Bernie Sanders in the Senate. And Bernie Sanders subscribes to this theory. And so do many others on the Democratic side, which is why they're proposing welfare programs including the Green New Deal, a jobs guarantee, whatever that means, free college, and Medicare for all that we've tallied, we've added up, would, on the low end, double the size of the federal budget over the next 10 years. So instead of spending about $50 trillion, the federal government would spend $100 trillion over the next 10 years. That's cumulative, what we're expected to spend. And then if you're looking at the more high-end estimate of the Democratic proposals, they could as well triple the size of the federal budget. And then they're talking about not just borrowing all the money, but just printing it. This is very, very dangerous. These are not only pipe dreams, but they're not benefit promises as much as they're promises of government control, vastly more government control over our lives, where bureaucrats and their cronies would be in charge of decisions. I mean, that's the other aspect of it. Beyond the fiscal impact, which would have a hugely detrimental economic impact, you also have to think about how these programs will impact people's lives in a very real way, where the government determines what treatments you'll have access to, what drugs you can get, and it would result in long waiting lines to see specialists to get things treated, like a heart condition, for example. We see much worse outcomes in countries that have socialized health systems like the UK. The National Health Service, you see much greater death rates and chronic conditions not being treated in the same way that we've come to expect here in the United States. So there's those real costs as well. And there will be effects on the labor markets. If we're paying people not to work, fewer people will work. That's why we're seeing this decline in labor force participation today, because the disability insurance program is basically a taste of what that looks like. And so I'm deeply concerned by where Democrats are taking this, and then also the lack of response from the Republicans. I'd be hard-pressed to name a champion for fiscal conservatism or responsible spending among the Republicans right now, because they have overseen a massive $4 trillion increase in spending just under President Trump's first term. And so they're no better. They're not promising all these new welfare expansions, but some of them have signed on to a proposal to create a new federal benefit in the form of a paid family and medical leave program. So you've got both Democrats and some Republicans promising new welfare programs, and nobody's talking about how we'll pay for all this, except us here at the Heritage Foundation. One of the things we've done is we've looked at how much more in taxes do people who live in Europe, who have these European-style welfare states that the left is promising to put in place here in the United States, how much do they pay in taxes? And we found that somebody making $40,000, the equivalent of that in Europe, would pay $6,000 more annually in taxes to their government than that same person making $40,000 in the United States. That's about a 15% higher tax burden. And if you make $100,000 in the United States, you pay roughly $16,000 more in taxes if you live in Europe at that income level. So those are huge costs that would be borne by the middle class, by workers in this country, that would drag down our economy. And if we want to live in a European-style welfare state, the American people should be prepared to pay those higher tax rates, because the alternative is going to be inflation if the government just prints the money. There is no free lunch. There is no easy way out. There are trade-offs, even if politicians are not willing to acknowledge them. So I'm glad we are talking about them.
I want to underscore one thing you said, and it gets back to the title of our channel again, Finance and Liberty, is not only does this spendthrift proposal of don't worry, we can just spend our way out of anything, we can create the money, whatever, not only does it pose a terrible financial risk, as you mentioned, for hyperinflation as experienced in Venezuela, et cetera, but also the liberty part, and you touched on that as well, is that people, this is that when you're told, think about it from a parental standpoint or whatever, as long as you live under my roof, as long as I'm paying for things, you're going to do things my way.
That's right.
Be careful what you ask for, because the politicians that come saying, I'll pay for everything, don't worry, I got it covered, I'll pay for everything, then have demonstrated time and time again that then they're going to call the shots. The federal government has done that many, many times with this, taking away rights and liberties otherwise enjoyed by the states and locals.
Right.
They say, you're going to take federal funding, you're going to do it our way. So your ability to live your life as you choose gets taken away when you sell out to that somebody else is going to pay the bills for you. And
you're right. This all-caring state that people think they want is going to be an all-controlling state. I don't think people want that.
That's the thing that I think people need to really be sober about. Is it's disingenuous. It's deceptive on the part of leaders saying, "Put me in power and I'll give you things." And people think, "Oh, that sounds good," and they'll put this in terms of, because we want no one left behind. We want to make sure it's for all, Medicare for all, and it's all inclusive. It all sounds like, oh, that's all good, right? Everybody getting things, but what they're not saying is it's going to be control, and it's going to be loss of liberty, and it's going to be loss of freedom that's going to come from that. So they don't tell you about the claws; they tell you about the velvet paw. But look, watch out what's coming right behind that. We have some questions from viewers, if we could transition over into that. Jason says, when will the problems in the entitlement programs, Social Security, Medicare, Medicaid, become politically undeniable? What would that look like, and how will politicians respond?
So right now, Social Security, Medicare, and other federal healthcare programs consume a little over half of the federal budget. And then if you add in other welfare entitlement programs, so-called transfer programs, including things like unemployment assistance, veterans benefits, federal employee benefits, you're looking at about 7 out of every $10 that the federal government spends being basically redistribution from one group to another. So it's already it's already very large. And then if you just look at the growth in this mandatory spending, that major entitlements, Social Security, and the healthcare programs, they will grow at 6% annually under current projections. If we had a great economy, we might get 3%. Most projections think it's going to be well below 2% annually. So spending is growing much faster than the economy, and looks to be doing that into perpetuity, which is highly unsustainable. But lawmakers won't act on most of these programs until they're absolutely forced to, and only some of them have dates, and they're not really expiration dates, but they are like dates when the spending authority gets reduced. Like for Social Security, that's the date when the trust fund will be depleted. We're already running deficits in the Social Security program, but the government's allowed to continue spending out despite taking in fewer payroll taxes than are necessary to pay benefits already today. Because of the existence of the trust fund, it gives them legal authority to borrow from the Treasury to continue paying for these benefits. So the date when that trust fund runs out of Treasury bonds, when the spending would be limited to what the government takes in revenues, that's currently projected to be in 2033. That number can always fluctuate depending on what the economy does. If the economy is strong, it might get delayed. If the economy is weak, it'll have to be dealt with sooner rather than later. For Medicare, however, the date, Medicare also has a trust fund, the Hospital Insurance Trust Fund, and that one's projected to be depleted much sooner in 2026. Now, the worry, of course, is that lawmakers will just paper over the deficit and try to pull money from somewhere else, most likely borrowing it to wait until they absolutely can no longer go on. Every lawmaker is trying to avoid having to deal with this problem because this is a problem that was generated decades ago, that we've continued to build on, and any lawmaker that's going to tackle it is going to face the political pain and consequences of dealing with this issue and making tough decisions that will likely mean somebody's going to get lower benefits than they were expecting, or somebody else has to pay higher taxes. I mean, those are your primary solutions. There's some things you can achieve with efficiency, especially in healthcare, by bringing in more market forces, by encouraging more Medicare Advantage plans over the government-run plans. Through competition, you can lower costs, where you can get some savings there. But in many cases, it will have to be some trade-off between higher taxes and lower benefits for certain people who can shoulder that more. But the real benefits from doing entitlement reform will accrue to future politicians, not the ones tasked with making the decisions, but the ones who will reap the benefits from a higher, more dynamic economy with more opportunity that will occur during their term in office, even though the reason for those benefits will be the politician who took the hit by making the entitlement reforms. And then the question is, who's going to be the one who will be responsible for that legacy, who's going to take the fall, but make the fiscally responsible, prudent decisions. And if we look at other countries, that normally doesn't happen until the government is so fiscally constrained that they see no other way out. And that's usually when their interest costs become a vastly larger burden. And we may be getting to that point soon, because interest on the debt, even at the very low interest rates the government is paying, has grown by 30%. The overall cost to the budget has grown by 30% over the past 2 years. So we are seeing a steep increase in the interest the federal government is paying. Now, some in the administration and outside economists are trying to encourage the administration to buy longer-term bonds, like to issue longer-term bonds, like 50-year bonds or 100-year bonds. Some countries have been able to successfully do that, including Germany and Australia, to lock in these low rates for a longer period of time to keep the party going for that much longer. But at any party where you overindulge, there will be a hangover. And the more you overindulge, the longer and bigger that hangover will be. So I don't think it's prudent to try and prolong the party by issuing longer-term bonds and lock in low interest rates. What we should be doing is moving towards a path to balance, gradually making those entitlement reforms. And there's still a way to do that mostly preserves benefits for vulnerable beneficiaries that are already receiving these benefits, but would generate much more opportunity, more choice, and better options for younger Americans, millennials, and those of middle age. But nobody wants to talk about those solutions. So either it's going to be the trust funds running out of money. Then the question is, will they actually tackle the problem, or will they just paper it over? Some of that will be what the American people demand at that time. Or are we going to get to a point where interest rates, the interest we pay on our national debt is going to get so big that politicians will be motivated to fix the underlying drivers, which are the entitlement programs, in order to free up more discretionary spending capacity. So it'll be in their own self-interest. We need to restrain spending on entitlements so we have more money to throw at our friends and fund our defense and do all the discretionary spending. That's what's happened in Canada and in Sweden and in other countries where in the 90s they found themselves severely restrained in their ability to do government management because so much of their revenue went to interest on their debt. And we're looking at interest on the debt growing to exceed what we pay for our national defense within the decade. So there's still, unfortunately, this may go on for longer than it should, but those, I think, would be the most likely triggers, absent some exogenous shock, like a massive recession that throws us in a fiscal crisis even sooner, or an attack like a war.
We've been speaking with Romina Boccia. She's the director of the Grover M. Herman Center for the Federal Budget at the Heritage Foundation. Romina, if people want to find more of your work, where can they find you online?
So most of my research is available at my profile at heritage.org, and I'm also on Twitter at Romina Boccia and on Instagram at The Lucid Economist, where I share much of my content. I'm always happy to entertain questions and interact with people. So appreciate the opportunity to talk with you about this key issue today. And just one more plug, if you'll allow me. We have a great website for people who want to learn more about federal spending and the debt, where their money goes. It's called federalbudgetinpictures.com. federalbudgetinpictures.com. It's a graphical, very visual representation of the federal budget in charts and graphs that I highly recommend. And then for the solutions, what do we do to balance our budget? We have our so-called blueprint for balance. It's our annual budget proposal to Congress and the administration, and that's available at heritage.org/blueprint-balance.
We're going to have you back on to talk about what individuals can do, both relating to their voting and their in exhorting their elected representatives to do the right thing and to show some backbone, that kind of thing, but also what they can do on their household and personal level to protect themselves and reduce their risk of the fallout from whatever comes ahead. Before we let you go, you have a minute to stick around for a bonus question for our Patreon supporters.
Okay, what's that?
So the question we're going to ask them is, this comes from part-time preppers asking, does Romina see any government bail-ins with 401ks or IRAs in the next few years? And before we let you answer that, folks, if you want to hear her answer, join us at patreon.com/reluctantpreppers, and you'll be able to get bonus content from this and other guests. So thank you again, Romina, for joining us this first time.
Thank you.
Hey, Reluctant Preppers, if you want to hear more bonus footage from other guests we've had on, come on over right now to patreon.com/reluctantpreppers and access that bonus footage there. Take care.
It seems so hard to order. Who can I trust, and how do I even start?
Oh, you just go to sdbullion.com/rp, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.